Welcome to Business with Louis, the show where we break down complex business concepts into actionable insights that you can use to propel your career or venture forward. I'm your host, Louis Riskwiser, and today we're going to explore a crucial aspect of personal and business finance: how credit scoring systems are evolving. In straightforward terms, credit scoring systems are the methods used by lenders to determine how likely you are to repay your debts on time. This concept is important because it affects not just individuals but also businesses, as it influences the interest rates they're offered, the loans they can secure, and even their ability to expand or invest in new opportunities. Historically, credit scoring has its roots in the 1950s with the development of the first credit scoring models by Bill Fair and Earl Isaac, who founded the Fair-Isaac Corporation, FICO. However, it wasn't until the 1980s that these models became widely used by lenders. The core principles behind credit scoring systems involve evaluating an individual's or business's credit history to predict future credit behavior. The most influential thinkers in this area include Bill Fair and Earl Isaac, as mentioned earlier, who pioneered the use of statistical models to evaluate creditworthiness. Over time, our understanding and use of credit scoring have evolved significantly, with advancements in technology allowing for more sophisticated models that incorporate a broader range of data points. For instance, modern credit scoring models can consider not just payment history and debt levels, but also social media activity, online behavior, and even rent payments. One notable example of how credit scoring systems are evolving is the introduction of alternative credit scoring models. Traditional credit scoring models rely heavily on historical credit data, which can be a barrier for individuals or businesses without an established credit history. Alternative models, such as those using machine learning algorithms, can analyze non-traditional data sources like utility payments, social media profiles, and even gaming activity to assess creditworthiness. This shift has the potential to expand access to credit for underserved populations and provide more nuanced assessments of risk. Another significant development is the increasing use of real-time data in credit scoring. Traditional models typically update scores periodically, such as monthly or quarterly. However, with the advent of real-time data analytics, lenders can now assess an individual's or business's creditworthiness based on up-to-the-minute information. This can lead to more accurate risk assessments and faster loan approvals. Real-world examples illustrate how these evolving credit scoring systems play out in practice. For instance, companies like Affirm and Klarna are using alternative data and machine learning to offer personalized credit options to consumers at the point of sale. These models can approve loans in seconds based on a consumer's online behavior, purchase history, and other non-traditional factors. For businesses, understanding how credit scoring systems are evolving is crucial for accessing capital and managing financial risk. A company like Amazon, with its vast trove of customer data, can use this information to offer personalized credit lines to its vendors or customers, thereby enhancing their cash flow and loyalty. On the other hand, small businesses or startups without an established credit history might find alternative credit scoring models as a lifeline for securing necessary funding. So, how can you apply the evolving nature of credit scoring systems to your advantage? First, it's essential to understand what factors influence your credit score and work on improving them. This might mean paying bills on time, keeping credit utilization low, and avoiding excessive new credit inquiries. For businesses, building a strong credit profile from the outset by separating personal and business finances and establishing a history of timely payments can be crucial. Tools like credit monitoring services and financial management software can help you stay on top of your credit health and make informed decisions about when to seek credit. Moreover, individuals and businesses should be proactive in managing their digital footprint, as this can increasingly impact credit scores. This includes being mindful of social media activity, ensuring online accounts are secure, and regularly checking credit reports for errors or discrepancies. In conclusion, understanding how credit scoring systems are evolving is more than just a matter of personal finance. It's a key aspect of navigating the business world successfully. By staying informed and proactive about your credit health, you can position yourself or your business for better financial opportunities and greater resilience in the face of economic challenges. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.